There is a massive shift happening right now when it comes to investments into AI stocks, into AI companies. And it's one that a lot of people just haven't seen coming and still don't see coming. Remember, just about a year ago, in 2025, AI spending was contributing more to GDP growth than consumer spending, than you spending the dollars you earn at your job. Let that sink in for a second. AI literally saved the economy from an almost definite recession. And you'd like to thank who other than Jensen Huang, right? The linchpin, the epicenter of the AI industrial revolution. He said it himself. Yet when we look at how stocks have performed over the last 30 days, any stock that has to do with chips, designing chips, manufacturing chips, powering chips, whatever it is, Nvidia sits almost at the bottom of them all. Marvell Technologies, Bloom Energy, Intel, AMD, ARM, Broadcom, GE Vernova, everything is outperforming Nvidia. Weird because they have the best performing chips, the highest margin of any company in the space by far. And yes, we could put up his pretty charts that he shows at the big events and earnings calls and whatever. But the only thing you have to know is, yes, it's true. Their chips are more performant than any other chips that exist on the market. But the key that a lot of people are missing, and the movement, the transition we're seeing away from Nvidia into these other players right now, is due to the concept of a zero-sum game. A zero-sum game being any game, any competition, any sport where one side's gain is exactly equal to the loss experienced by the other side. The prototypical example of the zero-sum game is poker, but it could be chess, checkers, baseball, basketball. The point is, one side wins, one side loses. Why is this relevant to Nvidia being the epicenter of the AI industrial revolution while every single company and their mother outperforms in spite of that fact? Well, it's exactly that. The AI spending game, the AI spending cycle that we're seeing right now is not a zero-sum game. It's so incredibly massive. And I'm sure you've heard of the AI capital expenditure spending at this point, but just know that the 4 biggest tech companies, we call them hyperscalers, they're planning on spending $600 billion on AI capex. What does that mean? Chips, building out power facilities, energy storage, cooling infrastructure, server racks, everything you could imagine having to do with getting their large language models up and running. $600 billion. A company like Amazon is spending $200 billion alone, almost enough to take them into making $0 in cash flow this year. So no matter what you think of the willy-nilly spending, circular spending, vendor financing, whatever you think, it doesn't really matter because the people that have the money and are able to spend that money are spending it at rates that we've virtually never seen before in human history. Does it draw parallels to other points of history? Yeah, of course it does. Does it mean it's going to end up like the dot-com bubble? No, not necessarily, but that's for a whole nother video. The question that we should be asking is this rally and all of these off-brand AI investments, your Marvell, your Intel, Bloom Energy, not necessarily the staple of the AI revolution, are these returns that we've seen over 30 days, 70% on Marvell, by the way, are these returns sustainable? Is this just a hypey move and investors start funneling back into your main player like your Nvidia, like your Taiwan Semiconductor? So let's talk about this using the data that we have right now. First, bringing this idea of the zero-sum game full circle and why that's so relevant, I just got to show you something right here. This is a chart tracking the price of renting a GPU, an Nvidia GPU, per hour over time. And you'll notice, like all hardware, the price depreciates over time. As a hardware falls out of style, as new iterations, new generations come to be released, the value of renting that hardware over the cloud is probably less valuable than renting the newest and greatest hardware, right? Assuming that the hardware continues to get better. This right here is the H100. For your perspective, the H100 was announced March 22nd, 2022 when Nvidia was trading for about $26 per share. My point is, a long time ago in the world of technology, especially AI, but when you look at this chart, look at what's happening on the right-hand side. We have a chip that was released 4 years ago, appreciating in rental pricing. Now, if that doesn't show how desperate the biggest companies in the world are, how important making these investments is to virtually every single company across the market and every country for that matter. You can see Jensen standing in front of this screen with just about every single company you could possibly imagine there. If this doesn't show that the whole AI space isn't just a zero-sum game and there's a ridiculous amount of money to be made elsewhere, even if you're not selling the most premium hot dog, you're still selling a hot dog and it works. Yes, Nvidia sells the best chips, the best GPUs the world has ever seen, thank Lord. But at the end of the day, there's so much demand that people are paying for chips that are 4 years old. I can promise you that AMD Marvel can rival the performance of a chip that came out 4 years ago. And hence we're finally starting to see a rotation into these plays that still need to catch up a little bit to the Nvidia multiple. Now that brings up a contentious point because, and you'd be right to suggest, that if we take a look at Nvidia's valuation, you can see that they're sitting at one of the lowest PEG ratios in recent history. Now, that's not the only way to value a company. Far from it. There's plenty of good ways, plenty of effective ways, but at the end of the day, a PEG ratio looks to value a company based on its future projected growth. Why did I say it's contentious? Well, because some people don't necessarily believe that the growth will be as big as institutions and CEOs imagine it will be. What we do know is Jensen Huang, CEO of Nvidia, is projecting that AI spend will be $1 trillion by 2028. Now, this chart was published in 2024, and at this time, every single financial analyst that you could possibly find thought this was absolutely outrageous. You'll notice 2026 lines up with roughly 600 to 750 billion, somewhere in that range. Well, remind me, what are we sitting at just between the 4 biggest tech companies in the world? Oh yeah, 600 billion. So yes, it sounded crazy. Now it's becoming more feasible. And this 1 trillion mark all of a sudden doesn't seem that insane. And hence why the PEG ratio might be super useful for Nvidia, because they're growing really, really fast. But there's a problem. The problem being this right here. Nvidia right now has a market cap of just under 5 trillion, followed by Google, Apple, Microsoft, Amazon. You've probably heard of these companies before. Keep this 4.8 trillion market cap in your head for a second here. This right here is a list of countries by GDP. You'll notice we have some big ones. We have the US, 32.5 trillion, China, 21 trillion, Germany, 5.45. And then look at this, Japan, 4.3 trillion. Nvidia would sit, if we put Nvidia here by their market cap and ranked it amongst countries by gross domestic product, it would be the 4th biggest country in the world. So yes, it's a very cheap relative valuation when we look at a PEG ratio basis. When you look at other ones, it's going to seem more expensive. But the point is, to factor in growth, you probably have to look at what the future holds, not what the past is showing. And with Nvidia destroying earnings every single time they make an announcement, you'd expect that the stock would be rallying to compensate for that. But we've been basically flat since about 9 months ago. So when we talk about those juicy multiples, the ability of investors to make a good return on their investment, obviously when we look at a company that's valued as the 4th biggest country in the world, compared to some of these other smaller players that haven't moved as much as Nvidia has over the past 3-4 years now, it might start to make sense why these moves have been so aggressive. Investors are chasing higher multiple returns, and it also adds fuel to the fire when we have a massive sell-off due to a geopolitical crisis in Iran versus the United States, and following that, a massive rally. This leads to speculation, risk-taking, and exactly what we just said, investors chasing higher multiple returns. What better way to get those in companies that haven't moved very much but are still seeing the benefit of $600 billion of capex spread amongst just 4 companies? Again, the spending is Looney Tunes. It looks on paper like an absolute disaster waiting to happen. But at the end of the day, the smartest people, the people leading the companies making the most money across the entire globe, those are the people making these decisions to spend this outrageous amount of money. So obviously they see some return on their investment coming, hopefully sooner than later. So this AI bubble that we're seeing doesn't pop right in every investor's face. When we look at a company like AMD, their valuation looks more expensive than Nvidia does. Marvel, way more expensive than Nvidia's does. G Vernova, my God, this one is insane. It literally does not go down, only up. The point is, yes, they're all eating from this same pie, right? If this was 2025, Nvidia has, 80 to 90% of the advanced GPU market. Whatever the number is, it doesn't matter now. In 2026, that pie is growing even bigger. Well, what does that mean? A tiny slice for Marvel could be a massive boost to revenue, to margins, to their financials, and set the tone for even more aggressive growth coming. And investors trying to price that in, and that's why we've seen it move virtually in a straight line up. Same thing with Broadcom, same thing with AMD, same thing with every single stock besides Nvidia. So what's the takeaway from all this? Well, eventually, assuming that at some point we build out AI infrastructure to be good enough to get to AGI, let's say, because that's ultimately the goal of a lot of these companies. Once we get to that point, companies will only want to invest, or most likely only want to invest, in the best performance they get per dollar. The more return they get on every dollar invested, the more profitable they are. Sweet. But that's not the case right now. Right now, Nvidia's making roughly like 6.5 million chips per year. If they could, let's say, triple that number to 21 million chips per year, they would sell literally every single chip that they make, but they can't. And the demand for chips is so extremely high. I mean, we're talking about Elon Musk and Tesla building a terafab, 1 trillion watts of compute per year, potentially generating enough compute per year than we currently have right now available to us. Now, obviously, this could be a pipe dream. We know Elon's usually a little early on his calls, but the point is, this is in work. And why do you think a company like Intel, a company dead in the water for the past 2.5 decades, is now reaching an all-time high? Well, they just talked about how they may be returning to growth, and Tesla is going to be a massive customer that makes them all that much more relevant once again in this zero-sum game. So at the end of the day, yes, the valuations aren't going to look as good on these other guys like Marvel, Bloom Energy, Intel, AMD, ARM, Avgo, GEV, but they probably still have room to run. There's a lot of momentum in this market. Doesn't mean there can't be a pullback soon. The market's been straight up and usually doesn't go straight up. But at some point when things get a little more dicey, a little more scary, maybe Marvel, maybe AMD slips up on execution, that's when investors will probably look back to the safer play, which is Nvidia. Safer play that's worth $4.8 trillion. So let me know what you think. Have you been involved in any of these other smaller plays, lower multiple plays in the AI space? And are you running in or running away? Check out marketspredictor.com. It's an AI assistant to help you invest, whether that's financial analysis, technical analysis, back testing over 25 years of data, whatever it is. Check it out. I'm sure it'll help you out. I wish you luck out there. I'll see you in the next one. Bye-bye now.